Good morning, everyone. This is Corey Hinkle with your Ankerstar Wealth Daily Update. We're going to look at a market update. I'm going to tell you about two things that are going on in the market right now that are creating a little bit of hesitancy for investors. We can't really say worries yet because we're sitting about 2% from all-time highs at the index level, but just a little bit of hesitancy from investors. And then there's one that I'm not going to talk about, which is also potentially going to start creating some hesitancy for investors, which is that government shutdown. Again, no hesitancy there yet. I'm not going to hit on that one today, but it is still out there. All right, but first, before I begin, I must remind you that this is a financial education presentation. You must do your own due diligence before acting on anything you hear in this presentation. More disclaimer information can be found at ankerstarwealth.com, and the opinions expressed today are just my opinions alone. All right, I'm going to jump over and give you that market update. You can see right now, and we're about midday here, we're up about 0.25%, 1/3%. You can see over these last 5 days, we've been mostly flat. Now, going back to last Friday, we had that sudden kind of unexpected volatility related to the president's Truth Social post, sort of going after, some additional tariff potential measures there against China. Those things aren't in effect yet. And, I'm kind of monitoring that situation. It's ongoing there. And I'm going to hit on that in a minute. But you'll notice since then, have we sold off further? We have not. Have we been able to recover back to all-time highs that are about 2% away? We have not. So not quite there yet. But we're not far away. And I'm going to hit on two things to sort of give you an understanding of why. All right, now first, a few weeks ago, we had some kind of notable bankruptcies or collapses that have hurt a few different financial institutions. And with this, they'll say, it's not when you find one, or as Jamie Dimon famously said earlier this week, there's not usually one cockroach in the kitchen. So implying that by the time you find one, there's going to be a potential or a likelihood that there's a few more in the kitchen somewhere or around. But First Brands and Tricolor, they collapsed. There's some fraud allegations there. For what it's worth, investors have are viewing this kind of right now as an isolated event or an isolated credit issue. Now, the regional banks have been, their share prices have fallen pretty sharply from this. You've seen some pain out there in the private credit space more broadly. So lots of private credit funds have sold off, some as much as 20, even a little more than 20%, in a few select cases where there was maybe a direct exposure to either First Brands or Tricolor. But again, it's unclear to investors now if these are more related to localized incidents of fraud or if there's a little something bigger there. Investors don't know. It's important to remember there's about 4,500 banks in the United States. And if one or two regional banks have an issue, it doesn't automatically mean that we're going to have a really big issue throughout the economy, right? Or throughout the capital markets as a whole. We saw that earlier this week. JP Morgan, if you go through, and we talked about it just briefly in our show earlier this week, if you go through every one of their business segments, they have provisions for credit losses. So here, consumer and community banking, provision of $2.5 billion. Charge-offs, so write-offs, maybe bad debt, was $2 billion, less than expected. You go to commercial and investment bank, credit losses was $800 million. Charge-offs were $567 million, less than expected. And there's another one here. There was one more here where, remember, they're planned for bad debt, right? You kind of account, and you're not going to hit them all in this business. So they account for what could go wrong. And every one of their business segments performed better than they had anticipated. So JP Morgan, biggest bank in the United States, they aren't seeing any credit issues out there. And again, the S&P 500, 2% from all-time highs. Investors aren't worried, but it has popped up. It's on the radar. Some would say it's actually a good thing that First Brands and Tricolor popped up on the radar, because then everyone's antennas go up. Every bank circles the wagons, kind of double checks to make sure they wouldn't or couldn't be another domino to fall in that saga, right? Which, of course, none of us want. Now, here's another bank that announced earnings today, Fifth Third. This is one of those regional banks. The bank is performing well. Now, you can see, if we look at their net charge-off ratio, it is up quarter over quarter from 0.5% to 1%. Now, it's up a little bit. Is this, again, nothing extreme to worry about, but just something to be aware of. And as these things pop up, investors pull back that risk just a little bit. Now, Jamie Dimon also noted earlier this week in that JP Morgan earnings call that there is possibly some excess in the lending markets. Think about it. You're a bank. Let's say you've got ample liquidity. Let's say you've got, $100 billion to figure out something to do with. And let's say $85 billion was really easy to put to work. You were able to assign that into some very high quality, credit options. But the further you get to using up all that liquidity available to you, you might end up stretching on that risk spectrum a little bit more than maybe you would have hoped you needed to. So, Jamie Dimon highlights that these might represent early signs that there was some excessive lending, some excess lending going on that could have not a fallout, but have some negative ramifications. And I guess in some ways we are seeing this in just a few isolated places throughout the private credit markets or the credit markets, I mean. Now, here's one thing that is important to remember. The economy is doing well right now. Consumers hanging in there. Employment's hanging in there. Rates are actually coming down. So lots of kind of good things going on. The Fed is lowering rates, right? Don't fight the Fed. When the Fed is helping you out with rates, that's generally a good time to be exposed to riskier investment assets. He does mention, though, keep in mind that some of these kind of unexpected credit concerns are happening during good times. And if that were to turn into not so good times, medium times, or less than good times, all right, less than medium. If you have a downturn, you're going to see quite a few more. Jamie Dimon pointed that out, which is a pretty intuitive thought. Again, just something to be aware of there. Now, there's one more thing out there. And again, we're just 2% from all-time highs. So it's nothing very concerning from a price standpoint. But last Friday, we had a almost 3% intraday move. We actually hit a new all-time high on the S&P 500 before reversing course to close like 2.6, 2.7% lower. That's a 3% intraday move, very rare, and really kind of extreme, right? It's rare and kind of extreme, an aggressive move. Now, what caused it was the Truth Social post where the president was kind of negotiating. He's sharing thoughts about some of China's trade policies related to those precious metals, things like that, lots of countries are interested in right now, in the AI boom, the EV battery boom, all of those things. And so that spooked investors. Now, are investors actually worried about the rare earths trade moving forward? That's not what investors are worried about. What investors are worried about is, hey, I can't quite go maximum risk right now that maybe I'd want to. And again, some of these are traders, right? They're not long-term investors. They're traders. They can't go maximum risk because headline risk right now is just a little bit elevated, whereas throughout most of the summer, it wasn't. It was muted. And so when the president introduced this idea of new kind of tariff-related risk or headline risk, Truth Social post risk, when that was reintroduced, investors are forced to kind of just scale back just a little bit. So you couple the new China, we'll call it negotiations, with the renewed, with the very small credit concerns, and the other one that I mentioned at the beginning, the government shutdown, which isn't over yet. Kind of basket those three together, investors are just pulling back a tiny bit. So that's all I have for you today. There's nothing, obviously we're aware of these things, we're watching these things. We don't have any extreme concerns, but obviously these things can change over time. So we're monitoring them, and we'll be your first source, right? So send us questions if you have any specific questions or concerns about any of these. Also, there was a tiny bit of volatility this past week. If that volatility in any way was a concern to you and your portfolio, that could be an early sign that maybe you are you're a little bit above where you should be on the risk spectrum. Reach out to your advisor. It'd be better to correct that now while we are at all-time highs than in a future hypothetical scenario where we maybe aren't at all-time highs. There's a little more volatility in the short term. So just be aware of that. Be aware of your emotions, right? The important thing is to stay in it for the long term. You don't want to do something in the short term that could kind of get you off that long-term track. So anyway, that's all I've got today. I hope everyone has a great day, a great weekend. Hopefully we can finish the day green. We'll see what happens. That's it. So I'll talk to you next week.